One of the most common requests I get from newer investors is to help clarify all of the different investing accounts and how they work. There are all these different acronyms: 401k, IRA, HSA, 529, Roth, traditional, pre-tax, post-tax, taxable, joint, individual brokerage. What do all of these mean? And does everyone need all of them? Well, we're going to do our best to make this very clear and simple. The good news is the core concepts are really quite simple. The bad news is that they deal with the tax code, so the details get quite complex. So we might skip over some of the complexity for now and just focus on getting a clear overview. We're going to start with this little guy. This is what most of us are most familiar with. This is what we've been dealing with since we were kids. A piggy bank. Money goes in, money goes out. That's all there is to it. This is essentially what your checking or savings account at a bank does. They might pay you some interest or have some added features like a debit card or checks, but it's essentially this. Cash goes in, cash goes out. Simple. But if you've been watching this channel for any length of time, you know that we want our money to grow. So we want to buy some investments too. So how do we do that? Well, the closest thing to what we're familiar with is a taxable brokerage account. I'm going to use this basket to symbolize a taxable brokerage account. Just like a bank account, cash goes in and cash goes out. But what happens on the inside of the basket, that's what's different. Inside of here, you can take your cash to a little supermarket and trade those dollars for investments. So you can take your cash here and put it into the account. You might take some of this cash and use it to buy a bond or a CD or a treasury, any sort of debt where you are loaning your money to somebody else for a certain period of time and they're paying you back with interest, right? So you can buy those. And what's happening is you're using the cash that's in that basket to buy that investment, right? Or maybe you take some of the cash in your basket here and trade it for a stock, right? So maybe you're buying shares of a company like Walmart or Amazon, right? And you are becoming part owner of that company. That's once again happening inside this basket. You're trading that cash for an investment, and then you're holding the investment inside this basket, this brokerage account. Or the third type of thing we'll talk about a lot is a fund. So you might take some of this cash and trade it for a mutual fund or an ETF, which is an exchange traded fund. What these are is where a company will go out and buy collections of different stocks or bonds for you, and they'll build out a portfolio. So when you buy that one fund, you're actually buying hundreds or thousands of different stocks or bonds, right? Just in one purchase. So this is what we're going to talk about a lot because I think this is the best way to invest, specifically with index funds. We'll talk about that in a different video. But you'll take the cash in your account, you'll trade that for shares of a fund. And then inside that brokerage account, you'll hold all those different investments, the funds, the stocks, the bonds, and any unused cash, okay? That's all just going to be inside the basket. So the most important thing that I want you to understand is that the account itself is not an investment. The account itself is a basket that holds investments and cash, okay? And so when we get into retirement accounts, things like that, it's going to work exactly the same way. The accounts themselves will change, but this process is going to be the same in all of the investing accounts where you put cash in and use that cash to buy different investments. And then you hold the investments in the account. Once you put money into it, you can buy any investments that you want to. And if you ever need to make a withdrawal, you just sell some of those investments, which converts that back to cash, and then you can withdraw that cash. These accounts are called taxable accounts because you don't get any specific tax benefits for using them. Any interest or dividends that you get paid while holding investments in this account will be taxable income for you. Anytime you sell something for a gain, that gain is going to be taxable for you. You do get a tax benefit for holding investments for more than a year before selling to encourage people to be more long-term investors. These long-term capital gains are taxed at lower rates than your ordinary income, so that will be important. It's almost always better to hold your investments for at least a year in a taxable account like this to get that tax benefit. But like I said, these accounts are similar to bank accounts, except for the fact that they are accounts where you can buy and sell investments inside of them. I say they're similar to bank accounts because they don't have any restrictions on when you can make deposits or how big deposits can be and when you can make withdrawals. You could deposit $100,000 one day and then withdraw it all again a few weeks later. No restrictions. So they're very good for flexible investing where you might need to withdraw the funds at some point. This is going to be different than retirement accounts, which will have limits on how much you can contribute and when you can make withdrawals. Let's talk about those next. So I'm going to be using these big locked metal boxes to symbolize retirement accounts. Why? Because these accounts have some restrictions. They have rules you have to follow. The government tells you how much you can contribute to these accounts each year, and they tell you when you're allowed to make withdrawals. If you make withdrawal early, with some exceptions, you have to pay a 10% early withdrawal penalty. But if you follow these rules, you get tax benefits. This is money that is for long-term investing, for saving for retirement specifically. So if you're willing to keep your money locked away until you're 59 and a half, the government rewards that behavior by giving you tax benefits. I'm going to start by talking about IRAs, or individual retirement accounts. These are accounts that anybody can open. You open the account for yourself. You don't need an employer to open it for you. But you'll want to confirm the income limits and contribution limits before you start contributing. We'll get into that in later videos. Now, I'm going to put labels on these that say traditional and Roth. Okay? So this one here is going to symbolize traditional, and this one is going to symbolize Roth. This is the next level of complexity that trips people up. But don't worry, it's actually pretty simple. All retirement accounts give you tax benefits, but the biggest difference between these different account types is when you get the tax benefit. So let me explain it to you this way. The traditional IRA, this one here, gives you a tax benefit now. The Roth IRA gives you a tax benefit in the future. If your tax bracket doesn't change between now and retirement, the benefit will actually even out. It'll be exactly the same between the two, no matter which one you choose. But if you think your tax bracket will be very different between now and when you retire, that's where things start to get interesting. A traditional IRA gives you a tax benefit now, meaning that any money you put into a traditional IRA will give you a tax deduction when you file your taxes. So if you contribute, say, $5,000 into a traditional IRA this year, then you'll get a $5,000 deduction on your taxes this year. It's just reducing your taxable income in the current year by the amount that you contributed. But when you make withdrawals in retirement, you'll pay tax on the money then. So that's really beneficial if you're in a high tax bracket now and you think you'll be in a lower tax bracket in retirement, because you're reducing your taxes now by getting that tax deduction when your tax rate is high, and instead you're agreeing to pay those taxes on the income in the future when your tax bracket will be lower because your income is lower, right? So that's why traditional retirement accounts are called pre-tax accounts, is because the money you're contributing to the account is before taxes or pre-tax, meaning you've never paid tax on it. Now, instead, let's look at the Roth IRA. Roth IRAs are the opposite. You don't get any tax benefit now. You don't get any tax deduction today. You pay tax on the money you're contributing to the account. But the money grows tax-free. So when you go to withdraw the funds in retirement, you don't have to pay any tax at all on those withdrawals. Even if the account has grown a lot, to millions of dollars, it's all tax-free. So that sounds great, right? We all love tax-free. And it is great if you're in a lower tax bracket now than you will be in retirement. Because that's what you're doing, is you're locking in today's tax rate by paying the taxes today and letting it grow tax-free, so you don't have to worry about tax rates in the future. If you're a high earner in a high tax bracket, then maybe traditional is more beneficial for you. There is no clear winner. Like I said, traditional and Roth are going to be equal if your tax bracket stays the same. The benefit to you is being able to choose when to pay the taxes, because then you can choose traditional and get a tax deduction when you're in your highest earning years, and you can choose Roth and lock in low tax rates when you're in lower earning years. And what a lot of people do, including myself, is to make contributions to both. It'll be really beneficial in retirement to have tax flexibility. That way you can withdraw just enough from your traditional account to fill up maybe your standard deduction or maybe your lowest tax bracket. And then you can fill up the lowest long-term capital gains bracket from your taxable brokerage account, and then use your Roth for withdrawals after that. Essentially making pretty large withdrawals from taxable and traditional accounts without paying anything in taxes. I mean, that kind of strategy is definitely going to come out better for you than it would have if you had just put everything into a Roth without having that kind of flexibility. One note about Roth IRAs before we move on is that they do offer a little bit of extra flexibility that makes me really love them, especially for people who are just getting started building out their financial accounts. I said that retirement accounts have early withdrawal penalties, right? So your money is locked away until you're 59 and a half. But that's not entirely true with Roth IRAs. Since you've already paid tax on the money that you contributed to the account, the government lets you take out your contributions, not the growth, but just the contributions themselves, at any time without paying any taxes or penalties. So, for example, if you've made a total of $20,000 of contributions over the years into this account, and it's grown to $50,000 because your investments are growing, you can't withdraw the full $50,000 without penalties, but you can withdraw the $20,000 that you originally contributed. So that gives you some added flexibility, which I think makes Roth IRAs pretty attractive as kind of like a backup emergency fund. Gives you a little bit more access to it. Now, I've been talking about IRAs so far, but what about other retirement accounts? What if you have a 401k or a 403b through your job? Well, those are still retirement accounts, so they'll have a lot of similarities. They're just retirement accounts that are provided by an employer. So while an IRA is an individual retirement account that you open up for yourself, a 401k is a big employer-sponsored plan. Your employer set up the whole plan and has accounts for each of their employees, and they manage it for you. Most 401ks these days have both a traditional 401k and a Roth 401k option. So it's going to be just like we talked about with IRAs, where you can choose to get a tax benefit now with the traditional, or you can choose to pay the tax now and get tax-free growth into the future with the Roth option, or some combination of both. But there are two big differences with employer-sponsored plans. One is that the contribution limits are much higher. You're just allowed to put more dollars into a 401k than you are into an IRA. And then there's the employer match. Most employers offer to match some of your contributions. Now, how much they'll match will vary from business to business, but it'll work something like this. If you put in 5% of your salary, your employer will match you and also put in 5% of your salary, or 3% or 6%, whatever it may be. But that is a huge benefit. That allows you to supercharge your retirement savings without cutting into your budget at all. So if you have an employer-sponsored plan, definitely check to make sure that you're contributing at least enough to get that full employer match. Otherwise, you're just leaving free money on the table. And while you're checking on your 401k, check and make sure that the contributions you're putting in there are being invested. Remember what I said about brokerage accounts. With investment accounts, it's always a two-step process. You put cash into the account, and then you buy investments with that cash. So your 401k might be doing that for you automatically, but check and make sure There's nothing worse than missing out on decades worth of growth in the market because you thought your 401k contributions were being invested, but they were just sitting in cash the whole time. So it's always worth double checking and just making sure that it's getting put into an investment for you. But let's sum up what we've got so far. So we have the concept of the bucket. All investment accounts are just buckets that hold whatever combination of assets you put into them. You deposit cash, but then you can use that cash to buy investments. You can buy and sell investments. All of that happens inside the bucket. And I'm going to say it again, just to be super clear. Investing accounts are a two-step process. You make the deposit of cash, and then you use that cash to buy investments inside of that same account. Don't forget to actually buy the investments. It's really important. Next, we have the concept of retirement accounts, that you get tax benefits in exchange for following certain contribution and withdrawal rules with those accounts. Then we have that Roth versus traditional discussion. Traditional gives you a tax benefit now, but you pay tax when you make withdrawals. Roth gives you no tax benefit now, but your investments grow tax-free, and you don't pay any taxes when you make withdrawals in the future. And finally, we have employer-sponsored plans. They are similar to individual retirement accounts, but they have higher contribution limits and can offer an employer match. Are you with me so far? There are offshoots, like 529 plans are investing accounts specifically for saving for college, or there are HSAs or health savings accounts. Those are investing accounts that are for healthcare costs. We'll cover those in their own videos, but just be aware they're similar to retirement accounts. You just get tax benefits if you follow their specific rules. Look, I'm not going to get all the way into the weeds yet. We will have future videos where we talk about how to choose investments for the different accounts, how to set up recurring purchases of those investments, how to choose for your specific situation, whether you should be doing Roth or a traditional or a taxable brokerage account. We'll get into all of that in more depth. I just want to make sure we have a firm grasp on these core concepts first. So if you have any questions here, definitely send me an email and let me know so that I know what to cover in those future videos. But how are you feeling? Is this overwhelming or is this starting to click for you? Let me know if the bucket analogy works for you. I was just talking to another friend about this concept, and I feel like the bucket wasn't working for her, but eventually we got to the point where we described it as like a folder on Dropbox, right? Like you have a folder on your computer and you can put cash into that and you can convert that cash into other things, but it's all inside that same folder. And I think that helped her conceptualize the idea of the investment account being a container instead of the account being the investment itself, right? What analogies work for you? If you have any other analogies that helped you conceptualize this, drop it in the comments. Yeah, it might help me with future videos, but also I think it might just help other people read through and see how you're visualizing it. Because I think this is one of those things where it's just a little bit abstract. And so I think people struggle with it. So anything you guys can do to help each other out. Anyway, thanks for sticking with me on this. I know this concept can be a little overwhelming at first. So like I said, drop me an email if you have any questions, and appreciate you being here. Hope you have a great day.